Hey, what's going on, everybody? We're going to surface analyze AFLAC today, and this came from a few community member suggestions. Happy to get into it. And for full disclosure, I don't own AFLAC, but I am a customer, and I thought I was going to need to use AFLAC when I took my come-along handle to the mouth, busted my lip open, took that big right hook from Iron Mike Tyson. What AFLAC does in the capacity that I use them or I have them is that if I couldn't work, then if I was off of work, they would pay me directly a percentage of my income. They would just give me that money and I wouldn't have to do anything else for it. So they are a supplementary insurance, as we will see. So without further ado, let's get into some quick surface analysis of AFLAC. AFLAC Incorporated, ticker symbol AFL, is a provider of supplemental health and life insurance in Japan and the United States. Their products are marketed at work sites and help fill gaps in primary coverage. They have a $32 billion market cap and are headquartered in Columbus, Georgia, and were founded in 1955. Their 5-year return with dividends is 79.7%, which did beat their industry at 72.1%. The dividend is currently at 2.88% yield, 38 years of consecutive dividend increases, and they did increase the dividend 17.9% beginning in Q1 21. In the last news release, their CEO did say, "We continue to invest in virtual and digital sales methods and promote new products." That's something I love to see. I like to see companies that are augmenting and transitioning into the digital space. Everything is digital. You have to figure out how to be more digitized if they are going to survive, and they look like they are indeed adapting. He also said it goes without saying that we treasure our record of dividend growth. Coming off our 38th consecutive year of dividend increases, I am pleased with the board's decision to increase the quarterly dividend by 17.9% in the first quarter. As we announced in November, our dividend track record is supported by the strength of our capital and cash flows. Their earnings per share payout ratio is currently a very low 17% and is forecasted to be 27% in 2024. 17.9% annualized 5-year earnings per share growth rate, 13.3% and 16.7% the last 2 years, 1% annualized revenue growth rate, 0.6% and 2.3% the last 2 years, and the cash flow grew 12.9% and 16.2% the last 2 years. And they currently have a very nice 21.1% profit margin. And I always like to check the trailing 12-month free cash flow payout ratio. All you have to do, as you see here on Yahoo Finance, is divide the dividends paid by the free cash flow, and I get 13.32% free cash flow payout ratio. Are you kidding me? That's incredible. That is one of the lowest payout ratios for such a strong company that I have seen, and I'm sold just right there. You had me at 13.32% free cash flow payout ratio. That means they have no problem increasing and paying that dividend. And the cherry on top is a 10-year 7% dividend growth rate. Man, that just looks pretty tasty. The interest coverage ratio. Now, this is a metric that I really love. I think it's way more important to look at the ICR as opposed to just looking at debt. Yes, you don't want debt growing, and too much debt is bad, but not all debt is created equal, and it really depends on what they are putting the debt into. If they are investing and using that debt to create assets that will generate even more revenue and income and growth, then that is all that I care about. And currently, AFLAC is at 17.81. So another way to say that is they have $17.81 of operating income to pay every $1 of interest expense, so they can easily pay that. There is no problem with the debt payments. Institutions own 69% of the shares, while the general public is second with 22.8%. And insiders have only sold shares in the past 3 months at the recording of this video. Simply Wall Street's valuation, what they do in a nutshell is they take estimates 10 years out and they discount those back to a price today. I'm going to do a video on this, how they come up with that number, but they have a fair value of $97.65, while Yahoo's 10 analysts, Yahoo, yes, a average of $44.70. The two of those together give me $71.18. That's a nice little mix because Yahoo is more near short term and Simply Wall Street is going 10 years out. So I think that's a healthy average combining those two together, which would make AFLAC about 35% undervalued at the current prices during this recording. So I don't own AFLAC as an investor. I am a customer and I thought I was going to need to use them, like now need to use them. Thankfully, I didn't have to because I'm going to get more money by working. The dividend increases, very, very consistent, solid, very solid cash flow. The payout ratio, again, at 13% of free cash flow. Are you kidding me? That gives me a warm and fuzzy feeling. And I need to invest in AFLAC. And as a dividend growth investor, I love the 7% 10-year growth rate of the dividend. They are just checking all the boxes. And I am going to be investing in AFLAC in the very near future, and we're going to turn that customer into a customer and investor. I'm going to get the best of both worlds. Let me know what you think about AFLAC. As always, you can check my bridge portfolio at Dividend. The link is in the description below. Follow me on Twitter at RustyRam78. You can also catch me on Instagram if that's your thing at Dapper Dividends. If you got value at any point in this, please give me a like and subscribe. I could really use it. I really enjoy doing this and spreading the word about dividend growth investing and adding my little bit of information to the community. And as always, expertise comes from the community. Let me know what you think about AFLAC. If I missed something, if I should have done something different, I want to hear it. Please let me know. And again, thank you for spending a little bit of time with me. You could be listening to anybody else in the world right now, but you're listening to me. I thank you for that, and I will talk to you in the next video.